We live in a fantasy world now. Reality has been destroyed.
This is the time that we really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is Lior Gantz, founder of the Wealth Research Group. How are you today, Lior?
I'm great. Thanks for having me back.
Excellent to have you. So, since the last time you and I spoke, there's been, a plethora of news and information. And maybe we can start by kind of getting your views, let's say, on deglobalization, this theme that we've seen really play out over the last 2 years, where supply chains have really broken down. And kind of the effects of that have in some ways caused a lot of the inflation we're seeing. So how do you see that having an effect on the prices that we're paying and the trends that we're seeing in the world today?
Deglobalization is probably the biggest overarching theme of our times. Globalization and deglobalization cycles are 40 to 50 year long. And we just finished a 60-year cycle that started in the early 50s and lasted basically a 70-year cycle that started in the early 50s and finished with the day that the CDC called COVID-19 a global pandemic, because that's the day when all these nations had literally the most unifying global event that everyone can come together and try to solve. But instead, every country focused on its own strategy. People fought each other over the narrative, over the severity, over everything. And we just saw closed borders, deglobalization starting. And what you're seeing with Russia and the Ukraine is further evidence that we're moving onto that deglobalized world. And as you alluded to, it's very inflationary. So let me start from the beginning on this. The last deglobalization cycle started around 1910. And if you recall, right after, there was the formation of the Fed in 1913, World War I, 1914 till 18, the Roaring 20s, the Great Depression, World War II. So a deglobalization period. And before that, it was in the mid-1800s when we had Civil War in America. We had the Napoleon Wars in Europe. Deglobalization is very destabilizing, inflationary, and ridden with wars. And that could be the cycle we're starting now and for the next 5 to 6 decades as China and the US, collide and clash in all sorts of ways, and the world gets deglobalized. And what that means is the trust between governments in terms of trade, cyber, intelligence, military, capital, ideas, and everything else is diminished. And instead of sourcing everything you need from the most efficient source, capital-wise, you go with the most efficient source in terms of your independence. And that is what you're seeing. When you have to source certain commodities or certain technologies from domestic economies, which can be more labor-intensive with more regulations, less favorable in terms of cost, but just more favorable in terms of politics and nationalization. That's what we're seeing right now. You saw classic examples of it during the last 2 years where you had trucks on the border of like France and Italy, for example, waiting for weeks, or, ocean liners and huge container ships that are stuck in ports that are closed or waiting in ports to be docked and offloaded. And there's a worker shortage because of unions and whatever else. This is obviously sort of the birth pains of everything, but we are definitely in a period of deglobalization that has started and will last for many more years to come. The Russian invasion of Ukraine is literally a commodity war. It's all about coal, natural gas, and oil. So you're seeing that play out. The China-Taiwan potential clash is about the future of who controls chips, because the Taiwanese semiconductor company is the quintessential and most important company strategically on planet Earth. Mm-hmm. And their chips are not made anywhere else. They're light years ahead of Intel and NVIDIA and all these other American companies and Chinese companies And the US government has celebrated investing like $50 billion during this CHIPS Act, but this company alone is going to invest $100 billion alone in their future, in their foundries. So all of this is about sort of dominance and clashes in the 21st century. And we are seeing that, this corporate exodus out of Russia is unprecedented. Globalization can end in a minute. All these companies that have been there for decades, like 3 decades since the end of the USSR, they're just vanished overnight. Agreements that they had in place with Germany and other countries can go away. It's been incredible to see. And the markets are discounting all of this turbulence. And obviously, deglobalization is hurting capital markets. It's creating higher bond yields, which means slower growth, more inflation, even stagflation in many places, and a lot of hardship for people that, to them, these increases mean the difference between more food on the table or not having enough.
So, Lior, as you're mentioning all of this, basically the war that is commodities based here with the conflict in Ukraine, how do you see that affecting Europe going forward? They're not even close to being energy independent. They import a lot of their energy. And if we kind of take into account as well, the amount of, let's just say essential metals that we need refined in China, that we need to manufacture a lot of the stuff in the US, like the electric motors and batteries, how does that start to play out? And does that just cause a lot of domino effect in prices as well to keep this inflation fire really burning?
Yeah, the governments of the world with their green initiatives and banning fossil fuels and whatnot, the market has called their bluff. You can see that in uranium and in other commodities that have skyrocketed, because when you create a situation where oil executives are fearful that a truck will roll by their property, they've spent tens of millions, if not hundreds of millions of dollars on new oil and natural gas, and the government can come in and slap them with an environmental fine that basically eats the first 2-3 years of profits. I mean, these oil executives don't like this current administration. They cannot work in an anti-business environment. This is going on in other places as well. And in Europe, it's no different. They talk a lot about banning fossil fuels, but when you look at the projections for oil, because of urbanization in the developing countries, Nigeria, Indonesia, India, China, and the countries that are growing fast in population and will be part of the bigger economies in the next 20, 30 years. In 20, 30 years, oil consumption will be, if not more than today, equal to today. Oil is not going away at all. So when you create a situation where the governments are against oil, but oil is definitely needed, you're creating an arbitrage between policy and reality. And that's why oil prices are so high and may remain high. That's why you see Buffett investing billions in an oil company, because the game has changed. So you're in an environment where governments want one thing, but reality is setting a different precedence, and it's creating higher energy prices around the globe. And I think that will remain with us for years to come.
So, Lior, when we think about, Europe really lacking its own energy sources, and even the US, how dependent they are on China for refining the rare earths, for example, that go into electric car batteries, electric motors, batteries, any of these things. How do you see that going forward to really affect those economies that have offshored all of this production? How long is it going to take some of these countries to be able to bring that capacity onshore?
Yeah, I think some of these countries will never do it, definitely in Europe. What we have basically is an arbitrage between government policy and free market reality. And you see that playing out best in the uranium sector, where the government policy towards oil was so unrealistic, it caused such a huge boom in uranium for the past 2 years. And I think if you look at the evidence and the facts and the data between Nigeria and Indonesia and Malaysia and China and India and all these other developing countries that are urbanizing and will need and consume way more oil in the next 20 years than they've done in the past 20 years, oil consumption on a global scale is moving much, much higher. So while it may be nice, politically correct, and even, some argue very beneficial for the environment and for the planet in terms of weather patterns and all that kind of stuff that governments seem to believe that have a lot to do with fossil fuels, the fact of the matter is that oil is not going away. And all of the ESG compliance, be it environmental or social or just regulation, is going to create a situation where energy prices are going to stay elevated for a very long time. It takes a lot of money and a lot of risk to put new projects into production because the reclamation costs, in other words, to put the project back and reclaim the area and make the area sustainable again after you're done with the resources, can cost hundreds of millions of dollars. The potential for slapping from government officials in terms of fines and new regulations is adding more danger and risk to oil and natural gas and coal production, just commodities production. So that's going to be inflationary. And then the biggest theme that we're seeing is what's called geopolitical capitalism. And that means that instead of a globalized capitalism where companies simply chase the cheapest and most effective way to produce something, and then they go for where there's labor arbitrage and regulation arbitrage. With what's going on right now, the real concern is not the price, but more the values. Countries want to do business with other countries that are like them or from their own domestic sources. And that's inflationary because, for example, in the US right now, we have one lithium mine, the whole United States of America. So when you want to be self-sufficient in terms of uranium in the United States, it's a pipe dream at this point. And I think people need to understand that because we are moving into a world where governments are going to put a lot of restrictions on where you can source commodities from, and that will be inflationary. So this is not something that's going away. I think that this will last for many, many years to come. It's a huge global arbitrage between what governments want and what the free market can do. And it creates opportunity, and it will also create distortions in the price of energy and the availability of things. Americans have never seen shortages. They've never seen just shelves empty and logistics being a problem because, these are genius companies like Walmart and Costco and Target. These are companies that are managed by logistic geniuses, and even they can't figure it out. So I think that this is something that you're going to keep seeing in many industries, shortages and problems in general, stuff that in America you haven't seen in 40 years.
Lior, we've talked about energy quite a bit recently on the show with let's say the energy cliff that some people see coming. Do you think that this higher oil price needs to be matched with a geopolitical attitude or a political attitude that is more conducive to companies going back out and investing capital in trying to create new supply?
Yeah, correct. That's exactly what I'm alluding to. The incentive of big oil to take profits and instead of distributing them to shareholders via dividends or buybacks or whatever other means that they want to do it, instead of that, investing in the future of their own business by purchasing new projects to replace the depleting ones, I think that is going to be tricky. A lot of oil execs are going to feel that it's much better not to invest in the future or to wait until the political environment towards big oil is not this problematic. The oil industry has received such bad press that you almost feel like they're bad people running oil companies, which is just not true. They're just people. So the fact of the matter is the stigma, the reputation that the fossil fuels have gotten as sort of this industry that's polluting the planet and causing weather patterns to change. And this is not going away. The public has been sold on these ideas. And I think in the developed world, we are going to see more and more of a move into green. But the reality is for the developing countries where environment is not that big of a concern, but their concern is more of their urbanization and how to get people out of poverty into the middle class and whatnot, and build their countries to the 21st century. Oil consumption there will be higher and higher every year. So if on one hand, companies are not investing in the future, and on the other hand, we need more and more oil, more and more natural gas, just more resources because the world is getting richer, you have a problem. You do have, you called it an energy cliff. I just think that the complexity that the governments are putting on energy producers is creating a lot of unintended consequences.
How do you foresee central banks dealing with this lack of energy and the cost of energy going up? You know, we see all around the world banks raising interest rates and this causing all kinds of downstream effects from that. And really, all of this is to combat supply side inflation by trying to crush demand. So how do you foresee central banks actually dealing with this, you know, in some ways, lack of energy that we're seeing in different parts of the world at this time?
Actually, that's a great question. I think that the central banks have taken the stance that their policy is only effective on the demand side, and therefore anything that has to do with energy prices and food prices and supply chains is supply side inflation, and the governments should handle that. If you listen to Chairman Powell with the 2-day testimonies that he gives in the Senate back in January and last week, he is adamant in this regard, and he will not deviate on this. He will keep saying that raising interest rates is supposed to balance supply and demand by basically influencing demand down. But there's a diminishing effect to that, because if you continue to raise interest rates and nothing changes in terms of energy prices, food prices, and supply chain congestion, all you're doing is you're bringing about tougher and tighter and poorer financial conditions for the people that own assets. That's all you're doing. Because if you think about it, Tom, when mortgage rates go up by this much and you're deterring people from originating mortgages, you're hurting the housing industry. The housing industry is the biggest employer in the United States, if you look at directly and indirectly. So you're literally creating a mini recession. Then if you look at the alternatives that the average person has, if he cannot originate a mortgage and he goes back to rents, it's not like mortgages are expensive and rents are cheap. They're both expensive choices. The best thing that can happen is if the government would permit more construction and work with municipalities to plan for expansion of cities, new neighborhoods, because America needs about 3 million new homes for all the millennials that are getting married and are forming families and moving out of their parents' house, etc. After this 2-year, basically, moratorium of marriages that we saw because of the COVID restrictions, a lot of people are getting married. There's a marriage boom in America. So housing, I think by raising interest rates, you're just making housing unaffordable for people who want to originate mortgages, but you're not alleviating their problems because they're going to go and rent for a high price because there's just not enough supply of homes. So when you look at energy prices, I mean, OPEC basically controls the price of oil. So it's not like something that the Fed can do. It can make people take less vacations and fewer drives. But, even if you take less vacations, most of the oil in America, it's not because people are on the road driving for fun. It's because they're commuting to work and shipping things around the country. So I don't see that as something that they can do with interest rates. And food prices is not something that the Fed can really influence. You're going to eat. So what I was really trying to tell Congress is And if you look at his previous speeches just last week, he's telling them the demand side is nearly exhausted. If we continue to raise interest rates, we are not doing anything efficient anymore. We're just crashing the equity markets and slowing down growth, but we're not helping the average person at all. So you should do what you need to do in terms of taxation, regulation, policies, incentives, and foreign affairs to help with oil, supply chains, and food prices, among other things. And obviously problems with labor and unions and whatnot. So I think that's what the central banks are going to continue to pound the table on, that their tool set is getting exhausted here, and they don't want to keep raising interest rates just to raise interest rates. The Fed today is a very different animal than in the 70s and 80s. When they just talk about their future policy, it already gets priced in to the markets. So it ends up being that they don't have to do actually all the things that they talk about. The classic example being in 2020, what caused the markets to bottom and start to rally in April was that the Fed said they were going to buy the junk bonds of all the Wilshire 5,000 companies, which is basically the largest index in the world of companies of junk bonds. And the market started to rally because here's the biggest central bank telling you that it's going to support all of the debt. Then in September of 2020, they disclosed that they never bought a single junk bond. Just saying that they will was enough to inspire confidence in the capital markets. So the Fed doesn't have to do a full worker in order to stop inflation. The more it communicates to the markets what it wants to do, the more the markets will already self-adjust, even if the Fed never does what it says it will do. So it's time for the government to stop dreaming about the BBB, the Build Back Better, and to start looking at ways that they can help the supply side of inflation. And with the midterms just around the corner, I think that they're going to start doing a lot of things now, and we'll start seeing more solutions. And obviously, we need to see more from them in terms of negotiations with Russia on some sort of a truce or a peace treaty or something, because that also is a big problem that governments can help and not central banks.
So, the increase in interest rates that we've seen, Lior, have driven and really over the last couple months, we've seen the US dollar really appreciate. But at the same time, comparatively or relatively to these other currencies, but at the same time, we're seeing a lot of moves by BRICS countries, for example, trying to find different ways around the US dollar. So how do you see this playing out over the longer term for the US dollar? Do you think it's ultimately doomed, or do you think that it's still the cleanest of the dirty shirts here, and it's not going to be easy for any competitor to come along to be able to provide the trust for global trade that the US dollar represents?
Yeah, I think Russia's invasion of the Ukraine has only further strengthened the importance of the dollar as a reserve currency. So its role is not diminished at all. Its reputation and stability, its integrity among fiat currencies has not only not diminished, but it's very strong. And I think that what we're moving into in the next, let's say, 10 to 20 years is a world where there's going to be two blocks. The countries that are US allies are going to use the dollar. They'll continue to use the dollar as a reserve currency. They may start to use other currencies or digital currencies or something that we can't foresee right now, but the dollar will be currency. And then China will continue to build trust in their currency and bring it up to standard on a global scale. And what they'll try and do is they will also try to bring nations to use their currency as a reserve currency. Classic examples would be Russia, India, Indonesia, countries that are in that sphere and may pivot from the dollar to the yuan. So what I see in the 21st century going forward is a little bit of diminishing use of the dollar, but not something that's a game changer. And then other countries that are going to use more of the yuan and some sort of an exchange rate between the dollar and the yuan. So there will be two reserve currencies coexisting for the two blocks, the Eastern Bloc and the Western Bloc. I do not see war because of this. The United States and China understand that their love-hate relationship is much more effective when they trade with each other and they do what they need to in order to help their economies along instead of trying to compete with each other on a military front. So two currencies and two blocks would be the way that I think we're moving forward in terms of the dollar's reserve currency role.
Mm-hmm. So, we spoke before about central banks trying to, in some ways, engineer a recession to try and tamp some of the inflation by affecting the demand side. Do you foresee a recession or even a depression coming because of this? And how do you think gold reacts in that environment?
I think we are in the recession right now. So obviously, lagging data will tell us whether or not we're contracting in terms of GDP 2 quarters in a row. But in my opinion, gold is 2022 is doing exactly what it needs to do in times like these. Gold is basically flat or up like 1% in 2022 as we're doing this interview, whereas the Russell 2000 is down 35%. The NASDAQ 100 is down 33%. S&P 500 is down like 23%. And I think the Dow is very near a bear market itself. You have countless companies, thousands of them trading at 52-week lows, multi-year lows, and some of them are down 80, 90%. And these are companies with revenues, some of them with profits and a bottom line. Some of them are dividend payers. So you are seeing certainly a recession of sorts. The one thing that's weird about this recession is that it's coinciding with a big labor shortage. So the labor market is very tight. The housing market is really good. But the way that interest rates are rising right now so fast, at such a fast pace, combined with what we're seeing in Europe, you are already seeing recessionary indicators that are happening in the real world. When somebody's retirement account goes from $1 million to $800,000 or less in 6 months, that basically is a very recessionary result. It means that he either needs to keep on working for a few more years instead of retiring, or he needs to delay any projects or anything else that he wanted to do. He just lost 20% of his life savings in 6 months. So I think we are seeing a drastic change in terms of our capital markets. And I think Main Street is going to follow because the markets are very forward-looking compared to Main Street. But we are already seeing it. And if we are seeing it, gold is doing very well. For gold to be flat while all these other asset classes are falling, and we know that in the first half, this was the worst year for the stock market since 1932, and the worst year for treasury bonds since 1887. So we're definitely in a shock period, in a large reset period for both stocks and bonds. And I think what's happening with real estate is becoming quasi an asset class, quasi a financial purchase that's not an asset. In other words, people are going to wait forever before they stop paying a monthly mortgage. So what you're seeing is a situation where real estate is not as volatile as equities that trade with a buy and sell order with algorithms all the time. If you were to take office buildings public and securitize more real estate, then it would be as volatile as equities, because there's no reason in the world where companies can fall 30% or 40% and lose hundreds of billions in market cap, and for the market not to say, okay, well, that means that real estate in that area is also worth 20% less because employees are getting less there and they're going to hire less, et cetera, et cetera. So real estate is artificially non-volatile. But if it was as easily tradable as equities, it would be just as much impacted as stocks and bonds. And what I'm trying to say here is that we may not see a classic recession where employment or unemployment goes up to the double digits and it takes a long time to get over the recession. It could be that the recession is already in motion and that what we're seeing in Wall Street will be far worse than what we see in Main Street in terms of the labor market, because the recession is an inflationary recession. So the hardships that people are feeling right now with energy prices and food prices, that could be the effect of the 2022 recession. We have to realize that we just ended a 13-year era where it was popular to stimulate the economy. And right now it's becoming unpopular to stimulate the economy. For the first time since 2008, pumping money into the system in order to save it is considered not the politically correct thing to do. What's now more, because of inflation, becoming a problem. Now what's the politically correct thing to do is like to do the Volcker behavior, which is to make the tough love choice for the country, not to be the mother goose and to pump, the printing presses, but to do what needs to be done in order to stop that. And that's a very different environment that we're getting into. We haven't seen that in many, many years. So I think that this paradigm shift is why people do not understand it. We're already in the recession. But certainly when you look at venture capitalism and tech and startups and growth and debt, they are all slowing down. In the last earnings call with Moody's is a company that basically rates bonds. And Moody's CEO said that in April, there were a few days where no junk bonds were being issued around the world. That's like unprecedented. That means no company is trying to raise debt. And raising debt is basically equivalent to growth. So we're slowing down hard. For the first time in 11 years, bonds are cheap compared to stocks. So everyone waiting for the stock market to come back roaring on the other side of this, I think he's going to be mistaken. And everyone that's trying to buy the stocks that are falling the hardest just because they think that there's going to be a V-shape on the other side, I think that they'll also be proven wrong. I think we're resetting valuations, we're resetting bonds to a world where the central banks are not there to accommodate for easy money policies. And I think that will last for years to come.
Lior, as you're mentioning, all these markets going down and resetting valuations, what do you think that we need to see for gold to really, for the next leg up? What do you think the catalyst for that is going to be? Is it going to be the Fed coming back in and, bringing interest rates back down? How do you foresee that being able to accelerate again?
Yeah, great question. I think that they will do what's called a dovish pivot. At some point, I believe, so the Fed funds rate is at 1.5% right now. And after the July 26th, July 27th FOMC meeting, they're going to raise by another 75 basis points. Basically, they're going above neutral, right? They're going to 2.25%. So at that point, they are already tightening very aggressively because they're over the neutral rate. I think what will happen is they will continue to signal to politicians that what they're doing is basically just front-loading all of these rate hikes so that they'll have options on the other side, and the market will see it in the same way. It's almost like they're fueling up because they know that they have to do something that's going to be, they'll need to cut rates at some point. So they're basically trying to create as much front loading when the economy is strong so that they will have the options to cut. And the markets will like that. So the more they raise, the more the markets are starting to price in the other side of this. But if the government doesn't do anything and oil prices remain high, food prices remain stubbornly high, rents and housing remain high, and supply chains remain congested, there's nothing hopeful from Russia and the Ukraine, I think that that's when we'll see a problem. If there are going to be solutions and we are going to alleviate some of this stress and pressure that we're seeing, after the July meeting, in the September meeting, I think they'll raise by 50 basis points, and they will start saying that what they needed to do, they have accomplished. They have set the precedents for lower inflation. What their policies have worked, they're going to basically claim some victory on this and continue to put pressure on the government to do their end. And that's the dovish pivot you're looking for. So around September is when I believe the markets will start looking at gold and say, okay, the Fed funds rate is about 2.75%. The 10-year bond is, let's say at that point, around 3.50 to 4. Rates have peaked, and now they're going to switch it around. But inflation is still going to be in the 7s with the CPI, or the high 6s. So interest rates are definitely still negative. And that means that even after all the tightening, we live in a negative interest rate world, and the Fed is going to start cutting rates. That's going to be the signal for gold to reprice itself higher, and it may even end the year above 2,000. Ultimately, in this cycle, to give you an idea of where I'm going with this, if you go to wealthresearchgroup.com/11, like 11, and /2022, the year 2022, you'll see 2 download reports that I created for your viewers and listeners about why gold is going to between 25 and 2,600 during this cycle. Gold is going a lot higher. And silver, when this happens, when this dovish pivot happens, and the dollar, because the cash reserves right now are extremely high around the world. When the dollar goes back to regular normal demand levels, silver has a very good shot of ending this year around 30 an ounce. So there's a big rally coming from September onwards for precious metals. And I don't believe people understand that precious metals will outperform the rally in the stock market. I think that the stock market is going to trade sideways for another year or so.
Excellent, Lior. Well, we have some interesting stuff in September to look forward to. Is there anything else you'd like to touch on before we wrap up here?
I think that if you're waiting on a huge housing crash, you should really look at the data and what's out there. Talk to realtors, talk to agents, and talk to fund managers. I think you'll understand that there's not this generational 2008 style real estate crash coming. None of the facts and none of the data supports that. And it looks to me like a lot of people are waiting to dance on grapes. And I don't know if that's coming. I think this is already 80 to 90% of the way through the pain and the discounts that we're going to see in the stock market. And I don't know if we're going to see huge discounts with real estate. So just keep that in mind, that this might be as cheap as you get in the sell-off for most asset classes. The risk reward is good enough in many asset classes. And in our newsletter, we put a lot of information right now about what stocks I'm buying in this environment and why I think the way that I think, what data I'm looking at. And you can actually subscribe to our free newsletter and understand more of what's going on, because I think people need to realize this is already a tremendous generational opportunity to buy after a very big valuation reset.
So you think most of the pain is over here?
Save for a very unforeseeable black swan that can always come. It can come today, tomorrow, in 5 years. It doesn't matter, that you can never price in. For all of the things that are already known and we're pricing in, the markets and real estate and everything else, it's already pricing in so much trouble and no solutions. If there's one thing that I've not seen in the first half of the year is solutions. I've seen only troubles. I've seen a war in Europe. I've seen hyperinflation and modern standards for a developed nation. I've seen supply chain issues, deglobalization, oil shocks, but I have not seen anything encouraging. And the markets are pricing that in. In fact, in the last 2 days, as we're doing these interviews with Finland and Sweden joining NATO, the markets seem to be already pricing in more conflict in Europe over this. So, when you look at companies out there, and I listen to about 3 conference calls a day of publicly traded companies. So in a given month, I look at around 80 publicly traded companies. Every cycle, every quarter, I go over the CEO calls of basically every large company in the world. And I can tell you that there are amazing companies out there able to innovate and outpace inflation and juggle through this. So if they're juggling through the worst political and economic climate that we've seen in the last 30 or 40 years, then there's a lot to be hopeful about, especially when you catch a lot of these on huge discounts. And I'm not talking about speculative stocks at all. I'm talking about world-class companies that you can hold for the next 20, 30 years. Happens every 15 to 20 years.
Excellent, Lior. Why don't you tell us where we can find those reports again?
Wealthresearchgroup.com is the website. On the top menu, I think you will enjoy a tab called Special Reports, another one called Watch List, where it's a lot of companies that I'm watching and researching. And of course, the newsletter is just the best way to keep up to date with what's going on. And you can subscribe to that for free.
Perfect. Thanks so much for your time, Lior.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.